Hello, Rick Comerick, Certified Financial Planner, coming at you today with a chart looking at the spectrum of returns in the context of risk, because risk and return must always be compared together. They're like two sides of the same coin. So let's take a look at it. Well, we have some major areas to consider here, like 100% stocks. We've got the stock market, or 100% bond, like in the bond market, or 100% cash like in the money market. So there's different markets that we can look at in terms of their returns as well as their risk or risk and reward. However, most of us want to look at some sort of blend between those. In other words, a diversified portfolio that has some stocks, some bonds, some money market, some real estate, some of everything. And if we do that, then we're going to look here in the middle. And what we see is that you can blend in various fashions, like a 50-50 as shown here, or a 60-40. A 60-40 is a good one to look at as sort of a benchmark to compare against, because that's kind of considered the institutional or Ivy League portfolio that they use. So if we look at that, we can see that the average return from 1926 to 2017 on a 60-40 basis was 8.77. Not bad. But in order to capture those returns, remember, the other side of the equation is the risk. And that means that from the period of 1973 to 74, there would have been a 25% loss. Also, in the dot-com crash of 2000 to 2002, there would have been about a 20% loss. And then, of course, most recently in our 07 to 09 credit crisis and recession that we had not too long ago, there was about a 27% loss. So in order to capture the reward, that's the style of risk that has to be exposed to and has to be endured, because you can't have your cake and eat it too. You've got to take the risk with the reward. But there are options, and this shows the spectrum of returns as well as the spectrum of risk that's available. If you have any questions about your investments, your risk, your retirement planning, feel free to give our office a call anytime.